You're ready to start investing in the stock market and build some serious wealth. That's awesome, but hold on for just a second. Before you go and throw your hard-earned money into the next hot stock you hear about, we need to talk. The truth is, the stock market can be an unforgiving place for beginners, and there are some classic pitfalls that almost everyone falls into when they're just starting out. I've seen it time and time again, and honestly, I've made some of these mistakes myself way back when. The good news is you don't have to repeat them. Today, we're going to break down the 5 most common mistakes beginners make in the stock market. These are the errors that can cost you a significant amount of money, cause a ton of unnecessary stress, and even make you want to quit investing altogether. By simply being aware of these traps ahead of time, you can sidestep them like a pro. Think of this as your financial cheat sheet to getting started on the right foot. We're going to cover everything from the dangers of emotional investing to why patience is your ultimate superpower in this game. My goal here is simple: to save you money and a whole lot of heartache. By the end of this video, you'll have a clear roadmap of what to do, which is often just as important as knowing what you do. So grab a coffee, smash that like button for the YouTube algorithm, and let's get into the rookie mistakes that, once you avoid them, will put you way ahead of the curve and on the path to long-term financial success. Let's get started. All right, let's get into the first and possibly the most widespread mistake: not doing enough research. I get the excitement. I really do. You see a stock ticker on the news. Your friend tells you about a company that's guaranteed to pop, and you feel this immense pressure to get in on the action before you miss out. This is classic FOMO, or fear of missing out, and it's a direct path to losing money. Jumping into a stock without understanding the business behind it is not investing. It's gambling. You wouldn't buy a house without getting an inspection or even seeing the inside, so why would you buy a piece of a company without knowing what it actually does or how it makes money? It's a recipe for disaster. Before you even think about hitting that buy button, you need to become a bit of a detective. What does this company sell? Who are its competitors? Is it profitable, or is it burning through cash every single quarter? You need to look at its financial statements, the balance sheet, the income statement, the cash flow statement. I know it sounds boring, but this is where the real story of the company is told. You can find all of this information for free in their quarterly and annual reports, which are usually on their investor relations website. Spending just a few hours reading up on a company can save you thousands of dollars and months of regret. Think of it this way: every dollar you invest is a vote of confidence in that company's future. You should be confident in what you're voting for. This means understanding their business model, their leadership team, and the industry they operate in. Are there long-term trends that favor this company, or is it facing significant headwinds? Doing your homework transforms you from a reckless speculator into a savvy, informed investor. It's the fundamental difference between building lasting wealth and just getting lucky for a little while before it all comes crashing down. Don't skip this step. Seriously. Now for the second major mistake, and this one is all about psychology, blindly following the crowd. This happens when you see a stock like GameStop or AMC suddenly skyrocketing, and everyone on social media is talking about it. The urge to jump on the bandwagon is incredibly powerful. You see stories of people making life-changing money overnight, and you think, I need a piece of that. The problem is, by the time a stock becomes a mainstream sensation and everyone is piling in, you're usually late to the party. The big gains have likely already been made by the early investors. When you follow the herd, you're essentially outsourcing your decision-making to a faceless, emotional crowd. You have no idea why they're buying, what their strategy is, or when they plan to sell. Most of the time, the crowd is driven by hype and greed, not by solid financial analysis. This leads to buying at the peak of a bubble, right before it bursts. The people who got in early are the ones selling their shares to you at an inflated price. Then, when the momentum shifts and the price starts to plummet, panic sets in, and the same herd that rushed to buy now rushes to sell, locking in massive losses. The legendary investor Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This is the exact opposite of the herd mentality. True long-term success in investing often comes from going against the grain, not with it. It means buying great companies when they are out of favor or overlooked by the masses. This requires independent thought and the courage to stick to your own research, which we just talked about. So, the next time you see a stock being hyped up everywhere, take a step back. Ask yourself if you're buying because of your own analysis or just because everyone else is. Your wallet will thank you for it. This brings us to mistake number 3, which is a big one: completely ignoring risk management. Look, investing in the stock market always involves risk. There's no way around it. No stock is a sure thing, and anyone who tells you otherwise is either lying or trying to sell you something. The difference between successful investors and those who lose their shirts is that the successful ones understand this risk and have a plan to manage it. The most common failure here is investing more money than you can comfortably afford to lose. If losing the money you're about to invest would dramatically impact your ability to pay rent or buy groceries, then that money does not belong in the stock market. Period. A crucial part of risk management is using tools to protect your downside. One of the most basic tools is a stop-loss order. A stop-loss is a preset order you place with your broker to automatically sell a stock if it falls to a certain price. For example, if you buy a stock at $100, you might set a stop-loss at $90. This means if the stock price drops to $90, your shares are automatically sold, limiting your loss to 10%. It's a safety net that takes the emotion out of the decision to sell and prevents a small loss from turning into a catastrophic one. It's a simple, automated way to enforce discipline. Beyond stop losses, proper risk management also involves diversification. This is the old saying, don't put all your eggs in one basket. If you invest all of your money into a single stock, your entire financial future is tied to the fate of that one company. That is an incredible amount of risk. By spreading your investments across different companies, industries, and even different types of assets like ETFs or index funds, you reduce your overall risk. If one of your investments performs poorly, the others can help balance it out. Managing risk isn't the most exciting part of investing, but it's what will keep you in the game long enough to actually build wealth. Let's talk about mistake number 4, and it's arguably the most difficult one to control: letting your emotions drive your investment decisions. The two most powerful emotions in the market are fear and greed, and they are your worst enemies as an investor. They cloud your judgment, destroy your strategy, and cause you to make irrational choices that almost always lead to poor outcomes. Greed is what makes you chase a high-flying stock that's already gone up 500%, convincing you it'll go up another 500%. You abandon all your research and principles because you're mesmerized by the potential for quick, easy money. This is how people end up buying at the absolute top. On the other side of the coin is fear. Fear is the panic you feel when the market has a bad day or week and you see your portfolio value drop. Your gut reaction is to sell everything to stop the bleeding. This often means selling solid long-term investments at the worst possible time, right at the bottom. The market is volatile. It goes up and down. That's normal. But when you let fear take over, you lock in your losses and miss out on the eventual recovery. History has shown time and time again that the market recovers from downturns, but you have to be invested to benefit from that recovery. Selling in a panic is a guaranteed way to lose money. The key to overcoming emotional investing is to have a logical, predefined plan and stick to it, no matter what. This is why the previous points about research and risk management are so critical. Your plan should dictate when you buy and when you sell, based on fundamentals and preset rules, not on how you feel on a particular day. One of the best strategies for this is dollar cost averaging, where you invest a fixed amount of money at regular intervals. This automates your investing and removes the temptation to time the market. By creating a system, you take your emotions out of the driver's seat and let your rational brain do the work. And finally, we arrive at the fifth and final rookie mistake, a complete lack of patience. We live in a world of instant gratification, and many new investors bring that mindset to the stock market. They expect to double their money in a few weeks or months. They treat investing like a lottery ticket, hoping for that one big win that will set them up for life. But here's the hard truth. That's not how wealth is built in the stock market. Real, sustainable wealth creation is a long-term game. It's a marathon, not a sprint. Expecting quick profits is a surefire way to set yourself up for disappointment and bad decisions. This impatience leads to two major problems. First, it causes you to sell your winners way too soon. You might buy a great company, see it go up 20%, and immediately sell to lock in that small profit. You feel smart for a moment, but then you watch as that same company continues to grow and compound its value for years, and you realize you missed out on a 10 times or 20 times return because you were impatient. The biggest gains in investing come from holding quality assets over long periods and letting the power of compounding work its magic. Selling early is like pulling a plant out of the ground to see if the roots are growing. Second, impatience makes you buy at the wrong time. When you're constantly searching for the next quick pop, you end up chasing momentum and jumping into stocks after they've already had a big run-up, which goes back to our point about following the herd. A patient investor, on the other hand, can wait for the right opportunity. They can wait for a great company's stock to go on sale during a market dip. They understand that time in the market is far more important than timing the market. So, shift your mindset. Think in terms of years and decades, not days and weeks. The stock market is one of the greatest wealth-building tools ever created, but it only rewards those who have the patience to stick with it. So there you have it, the 5 most common rookie mistakes that can derail your investing journey before it even gets going. We've covered not doing your research, following the herd, ignoring risk, letting emotions take control, and being impatient. It might seem like a lot to remember, but honestly, just being aware of these pitfalls puts you in a much stronger position. Every single successful investor you can think of has either learned to avoid these mistakes or learned from them the hard way by losing money. You now have the advantage of learning from their experience instead of your own empty wallet. Remember, investing is a skill that you develop over time. You won't be perfect from day one, and that's completely okay. The goal isn't to never make a mistake. The goal is to learn from them, refine your strategy, and become a smarter, more disciplined investor with each passing year. These principles aren't just for beginners. They are the foundation of a successful long-term investing strategy that will serve you for your entire life. Avoiding these traps is your first major step toward achieving your financial goals and building lasting wealth for yourself and your family. If you found this breakdown helpful and you want to continue learning how to invest intelligently and build wealth the right way, make sure you smash that subscribe button and turn on notifications so you don't miss any future videos. I post new content every single week designed to give you the knowledge you need to succeed. And as always, thank you so much for watching. I appreciate your time, and I'll see you in the next video.